Today, we're going to start the session with a conversation with Mohanjit Jolly, partner at Iron Pillar. Mohanjit, welcome to the show.
It's a pleasure, Samna.
Well, it'll be a great conversation. I'm sure you've been in the industry for a very long time and have been following the evolution of the Indian venture capital ecosystem quite for a long time. So let's start diving into a bit of, just for introduction's sake, just a bit of your background, and then let's introduce Iron Pillar, and then we're going to talk trends, talk about the historical backdrop of the Indian industry, and so forth.
Absolutely. Again, thank you so much for having me. From a background standpoint, I am what you call an IBCAD. You may have heard of ABCD, but IBCAD is an Indian-born, confused American Desi. So born in India, moved to the U.S. when I was a teenager. So I did my high schooling, college, graduate work, et cetera, here in engineering, in aerospace. Spent some years on the defense contracting side, actually building spy cameras for the U.S. military. Was part of the team that fixed the Hubble back in the mid-90s. UCLA MBA, launched an incubator at Caltech back in the late 90s. Did a joint venture with Andy Grove at Intel while I was at Mattel, the toy company. And then I got a cold call from Guy Kawasaki, who's a bit of a legend in Silicon Valley, prolific speaker, author. And he had started a bank, an investment bank called Garage, which pivoted to a seed stage venture capital firm after the dot-com crash back in the early 2000s. So I'm an accidental venture capitalist, but I've been working with startups for about 23 years now, initially helping them raise capital, and then over the last, almost 20 years, directly investing. So I was with Garage. That was the firm that Guy had founded back in the early 2000s. And then I was with DFJ and Tim Draper from 2007 till December of 2015, and then launched Iron Pillar in January of 2016. And we're sort of 6.5-year-old new firm and having a blast through the ups and downs.
Great. And how big is the Iron Pillar fund size-wise?
So I can give you a historical perspective. Not allowed to speak about what's going on currently, though. You will know that as and when we get certain milestones. But historically, we started the firm in 2016. We actually did not raise capital in 2016. We started the process in 2017. We raised a $90 million fund. That was our fund one. We had $90 million in commitments. We invested in 8 companies from that particular fund. Then, as one does in the middle of the pandemic, we decided, why not? Let's go out and raise another fund. So we raised a $48 million, what we call a top-up fund, to double down on the winning companies from Fund 1. And so that got oversubscribed, believe it or not, in sort of May, June of 2020, early days of the pandemic. And now, we're on to our next vehicle, which I cannot give you details about, but we've been closing and deploying capital, in our most recent fund vehicle as well. And I'm happy to talk about some of those investments in this conversation.
And let's talk about the positioning of the new fund. Is it a seed fund, post-seed fund, Series A, or pre-seed? Where are you positioning the new fund?
Yeah, so it's interesting. My journey, so again, with Garage, it was seed stage. I was writing 250 to 500K checks. Then DFJ was more of a Series A, prototypical Series A investor. Iron Pillar is actually further sort of downstream from that. So our stage of the company where we invest is usually post-product market fit. And the focus for the fund, the current vehicle, is invest in companies that are building from India for global markets. So from India for the world is the thesis, which then leans more enterprise, more B2B than it does B2C. However, we do have sort of an 80-20 rule, if you will, or a guideline to say, 80% of the companies are going to be more B2B SaaS, 20% maybe more consumer centric. All of them are going to leverage the cloud, and all of them, of course, are heavy technology companies. So from a stage standpoint, we're more a post-Series A, maybe an A plus, a Series B type of investor, and we call ourselves early growth. So what that means is when companies, for example, on the enterprise side or the SaaS side, get to somewhere between 4 million and 10 million in ARR, is when we come in and lead or co-lead rounds. Having said that, one of the reasons I was actually intrigued by what you are doing is we actually start tracking companies much earlier than when they need our capital, right? So even when they're seeded or they do their, Series A or somewhere between seed and A or whatever the new avatar of that round, from a name standpoint is, we start tracking interesting companies, engaging with them, building that rapport, so that when they get to a point where we get excited from a direct investment standpoint, we can potentially preempt the round, and we've done that with a couple of companies in our Fund 2 portfolio.
Mohanjit, can we talk about you said you started your first fund you invested in 8 companies and then you continued to invest in those 8 companies. Let's talk about some of them, and I just want to get a flavor of the kinds of companies that drew your attention until now to give a sense of what you would be interested in going forward.
Absolutely. So look, Fund 1 was, and we have a concentrated portfolio strategy, by the way. I mean, most of the folks who you may have as guests on the show, may do 20, 30, 40 investments per fund. In our case, the numbers are closer to 8 to 10 investments per fund, and there's method to that madness. But I'll get to that in a bit. But specifically to your question, first fund was 8 companies. 3 of them were what we call India for India. So companies like Bluestone, which is a omni-channel jewelry company, one of the largest sort of privately held jewelry companies in India. We invested in a company called Testbook, which was an ed tech play for government exams, for example, because we felt that was a sizable market in India. And then the third company, which we actually ended up selling to Reliance, is called NowFloats. And NowFloats the idea was go after small kirana shops, small store owners, and give them an incredibly easy way to get their businesses from a pure offline into an online or an omni-channel kind of play. And to be able to do that.
NowFloats was in 1Mby1M long time ago. So I knew
Is that right?
NowFloats.
Okay. Yeah, so we led their Series B, and we actually played a very critical part in eventually getting that exit. And that's an entire that's an interesting story in and of itself in terms of why we decided to sell at that point versus continue the journey over a longer period of time. So those 3, NowFloats, Testbook, and Bluestone, are more India for India stories, and then the remaining 5 are really India for the world. And I'll focus, I guess, on 3 of those remaining 5, which may be familiar to the audience and have really broken out of Fund 1. So the first company is called Uniphore. Uniphore is a conversational AI platform that most recently raised $400 million, led by NEA in their Series E. This was earlier this year. And the idea is to go after, large enterprises that have more than 500 call center operators, either captive or through other BPO services. And how do you leverage AI to remove human from the loop and have that human be a higher value add layer in that entire engagement, and then to be able to do so globally in dozens of languages, and be able to actually have intent or emotional sort of context in that conversation to understand whether the customer is actually getting more annoyed or are they moving towards a resolution and delight. So the company has done incredibly well. What's really interesting about that company is they spent 7 years in India perfecting the technology. They were in India Private Limited, incubated at IIT Madras, and then when John Chambers, the former CEO of Cisco, led the Series B back in 2016 or early 17, his prerequisite was that Umesh, the CEO, had to move to Silicon Valley. So the company then, or Umesh then moved to Silicon Valley. The company flipped from an India private limited to a Delaware C corporation, a U.S. Inc. And we invested back in 2018 in their Series C, and they've raised two follow-on rounds since. So that's one company that's truly broken out and is valued at multiple billions of dollars. The second one, which is really interesting, is a company called Servify. Servify is an insurance tech play or insurtech play based out of Mumbai, but now present in 55 countries around the world. And what they do is basically it's a device lifecycle management software company. So whenever something goes wrong with your mobile phones, et cetera, they are the go-to player for most of the OEMs, actually all of the major OEMs in India and many of the OEMs globally, to manage the post-sales servicing and warranty for that particular device. And amazingly enough, here's a company that's still in India, private limited. The CEO sits in Mumbai, but they now have companies like Samsung and OnePlus that have brought them to Europe, to the US. They're in other conversations. They run Apple's and Samsung's warranty servicing in India and other parts of the world. So that's another one. And the third one, which is another consumer play, but an interesting one nonetheless, is a company called Fresh to Home. Fresh to Home is a vertically integrated fish, meat, poultry company where the idea is remove layers of complexity and middlemen and go from source to doorstep in 24 to 36 hours. Hence the word fresh in the name of the company. And so it's just absolutely remarkable. The company itself is domiciled in Singapore, started, of course, in India primarily, but has now extended into the Middle East. So they're in UAE, and they're going to other parts of sort of the Middle East and GCC going forward. So it's a mix of enterprise, SaaS, some consumer, India for India and India for the world. That was a Fund 1 blend. Then we raised a top-up fund. Top-up fund was to invest in these three companies in particular, Unifor, Servify, and Fresh to Home. And we did deploy that capital. But with Fund 2, the thesis has shifted slightly, which is invest in companies that are building from India for the world. So there isn't necessarily a component of India for India from Fund 2, but it's really India for the world is the.
Why did you make that decision?
It's interesting. Well, one of the reasons is I'm sitting in Palo Alto, so I'm not going to be investing. I don't have my finger on the pulse necessarily of what's going on in India. Having said that, I have my colleagues who are in India and the Middle East, and they do have their fingers on the pulse. But here are the three reasons why we as a partnership decided, at least for the time being, with Fund 2 to go down this path. One is we think because of the democratization of the technology stack, thanks to hyperscalers like AWS, Google Cloud, Azure, et cetera, you can have world-class people sitting anywhere in the world building world-class products for the world, right? And who better to do it than software developers and software engineers and just brilliant minds in India, right? And one thing that the pandemic has taught us is clearly you don't need to be in a particular geography, right, to have an impact in that geography. So we were thinking about this well before COVID happened, but COVID seems to have accelerated that particular thesis. So one is democratization of the tech stack, so you can have people sitting anywhere in the world building for anywhere in the world. Second, and this is quite important to understand, is the currency risk, right? So from our standpoint, the rupee depreciates 3, 4, 5% a year, and therefore, to get returns in dollars, which is where most of our LPs are investing, you have to run 50% harder to get the same returns in dollar amount rather than rupee amount. So to give you a precise example, I was in India from 2007 to 2012. In 2007, the rupee was somewhere around 38, 39 rupees to a dollar. When I left in 2012, it was at 62, 63. And therefore, in rupee terms, if the portfolio does really well, it doesn't mean a whole lot because in dollar terms, we were taking, 50% hit purely based on currency. So when you have this India for the world thesis, the currency depreciation actually helps you, meaning the revenue is in dollars and the
The
costs
cost
are
is in rupees.
in rupees, right? So most of the companies that we've invested in out of Fund 2 thus far, I would say something like 75, 80% of the headcount is in India, right? 20% or so is in the US, right? So it's a wonderful outcome from a unit economics standpoint. And so the dollar goes much further in that sort of B2B side of things. And the final piece is we looked at literally hundreds of companies and we sliced and diced the data. And what we figured out is the India for the world story, has 2x the exit outcome. What I mean by that is for every dollar invested, you're able to extract $2 out, twice as many dollars out, I should say, for an enterprise-centric company than a consumer-centric company. So enterprise-centric companies tend to be more capital efficient. So they take about 50% of the capital to get to quote unquote unicorn status than a consumer-centric company does based on the analysis that we've done, right? So it's capital efficiency, it's repeat appreciation. The final thing is exit optionality. So if you have companies that are building from India for the world, whether it's acquisition, whether it's IPO, you just have a lot more options. If that company, let's say, is it could be a Delaware corporation, it could be
basically.
That's correct.
Yeah.
That's correct.
A couple of questions out of what you said. One is you hinted earlier that there was a story behind selling Now Floats to Reliance, and there was some thought process behind it. I'd love to know what that was, because Reliance has become a very interesting player in the startup ecosystem, and they completely changed the game with Jio. What happened, and how did that play into your cycle?
Yeah, so I think it had less to do with Reliance, to be honest, but more to do with the fact that, we realized that without going into a lot of details, we realized that, the company was hitting a bit of an air pocket in terms of predictability, replicability, and scale, right? So you've got to figure out your go-to-market engine, which the company was struggling with a little bit. And then you have to have sort of a retention strategy. So you can't just be, constantly churning and acquiring and churning and acquiring, just not something that's scalable. So that was a little bit of what, the company ran into at that point. Again, it was an early investment. We invested in the company back in 2016. And so timing, right, was everything. And so, Geo hadn't quite happened yet.
Okay.
It was still, some of the prerequisites for that particular company to succeed from a consumer mindset, from, technology adoption, et cetera, was not quite there. So I think timing in these things plays a big role. And I would equate timing.
And selling, one of my observations on Now Floats would be that selling to SMBs, especially that small businesses in India, is really hard.
That's right. That's right. And so, you've got to have, feet on the street. The dichotomy in India, especially on the SMB side, is the following, which is Indians love to be pampered as customers, right? Whether you're on the SMB.
I touch low value sale.
So exactly. So, they want the high touch, but the high touch doesn't work, right? The unit economics simply don't work unless you. Yeah. So that was a conundrum. And look, the interesting thing is we actually had a strategic term sheet on the table. I won't say who, but it was one of the financial institutions in India. And so the board had, long deliberation around this, and I give a lot of credit to my partner Anand, who basically convinced the board and management to say, "Look, guys, even if we take this particular capital, and wasn't a lot of capital, right? We would basically be kicking the can down the street. We would have added somebody else on the stack. And so rather than do that, let's put a bow on it and find a new home where the team and the employees, everybody can continue to build this platform with the right kind of depth and breadth and reach. And so Reliance was therefore, when we started the process, a natural home for the company. And as far as I know, they're doing extremely well.
Which is a good segue into my next question. I completely agree with you that when the India-born global SaaS is on the deck, exits are kind of the same exit options as any SaaS company, right? It's basically, especially if it's enterprise software, the exit options are very standard. It's general. It's real democratization of exit options also. Talk to me a bit about how the exit options in India have evolved for the rest of the venture-backed companies.
Yeah, look, I mean, I've been investing in India for the last 15 years. And as you alluded to, I've seen India evolve over time. One of the biggest issues that, when we would go and pitch India, and the LPs and the other VCs would say, well, we haven't quite jumped into India yet because, a lot of capital has gone in, not much has been delivered in terms of harvest. I think that story has clearly changed, right? Flipkart was the watershed moment, if I can just point to that. But then one can look at, Freshworks as yet another watershed moment on the SaaS front. Exactly. And
Freshworks doesn't fall in that category.
Right. And look, I mean, one of the things I've been saying for a long time, though, is the following, and this is a little bit controversial, right? Which is you have to look at India from a relative lens, not an absolute one, right? So when people fall into the trap of absolute returns and saying, well, US has returned this and Israel has returned that and China has returned that, and look at India, it's only a small piece. Then you're sort of convincing yourself why India is not an interesting, geography to look at, right? So then you sort of say, okay, it's very hard for me to sort of convince you from that point. You'll just have to come to a different state of mind on your own based on data that you gather. But if you look at India from a relative lens, I mean, India today is orders of magnitude better from an exit scenario, an exit possibility standpoint than it was, a few years ago, right? Yes, one can argue the IPOs happen and the Paytm and so on. It was a bit of a tumultuous, let's just say, journey, but cycles happen and headwinds come, and sometimes you get caught, right? And that has happened in every cycle. But the good news is that there is now a pathway, and there'll be others. There'll be Mobi and Dhruva, and there are a bunch of folks who have reached critical mass. They're doing, phenomenally well in terms of top and bottom lines. The public markets, as and when they come back, there will be a rush, and I think there will be, several Indian companies or Indian origin companies or companies that started in India and then pivoted to a U.S. Inc. They will be in the mix. And that's when we'll start pointing to that data. Now, having said that, there's been also a bunch of M&A that has happened. Now, M&A may not be 100% acquisition. It may be controlled transactions, right? So several of those, Simply Learn and others have also happened, which have provided liquidity for employees, for entrepreneurs, for VCs. And so now you're in an environment where there are billions of dollars that have been returned to GPs and therefore LPs. And so that cycle is starting to mature. Now, is it a well-oiled machine, and is it going, like a Ferrari or a Lamborghini? Not yet, but we're somewhere between a Maruti 800 and a Ferrari, I would say. And I'm very bullish on the prospects going forward.
There are two trends that I have observed, and a lot of this is captured in my other conversations with your compatriots. One is that the Indian VCs who have done early stage investments, and in some cases where the company has gone on to become a unicorn, let's say, or a heavily funded later stage company, the early stage investors have sometimes exited into those later rounds. This is a trend, definitely. In India, there's almost like an early stage investors exiting into later stage investors. It has become a trend. That's one.
Yes.
And the second one is, capital efficient companies exiting into heavily funded companies. That also seems like something that is happening, is that there is a class of companies that are becoming the unicorn, heavily flushed with capital companies. And then there are others who have, good metrics and good teams, good, etc. And they're being acquired by those heavily funded companies. These are two, I would say somewhat newer trends and somewhat different trends than what we see in Silicon Valley or the US in general. The trend of earlier stage VCs exiting into later stage VCs is not as big a trend in the US market. The one that's about capital efficient companies being acquired by unicorns is, I think, a global trend at this point, because these unicorns are having a hard time justifying their valuations, and that's where they're looking for shortcuts to backfill the valuations at which they have raised money. So I think that's definitely happening in India. Very interesting conversation. How long do you think it will take for the Maruti to become maybe doesn't have to be a Ferrari or a Lamborghini, but maybe at least a BMW?
So I think when we come out of this sort of cycle, my belief, my projection is the following. I think next year will be a challenging one, but when the next bull run starts, India is going to be playing a pretty big role in the outcomes of that point. And when I say a pretty big role, even though we come out with an annual sort of unicorn report and we've sliced and diced the data, I'm less interested in the term unicorn. I am more interested in the underlying value that these companies are providing for their customers, right? So if you have on the vitamin to cancer drug spectrum of products closer to the cancer drug than the vitamin, then you're going to have that customer for a long time, right? You're going to have really interesting, and you have interesting gross margins and year-on-year growth and retention and so on and so forth. Whether the market values you at 30 times multiple or 15 times multiple or 10 times multiple, you are going to create value downstream. So as long as your focus is on that and less on whether you're labeled a unicorn, which I think unfortunately a lot of especially first-time entrepreneurs got into, because they wanted that stamp. I think they did some unnatural things to get to that stamp. I mean, there's some crazy situations where companies raised $25 million or $30 million just to be able to say, hey, we raised money at $1 billion pre. It makes zero sense, right? And now the same companies are.
It's no sense at all.
Yeah, doing down rounds and so on. So my answer to your question is, I think it's not going to be a long time. I would say 3, 4, maybe 5 years. When we come out of this J curve, you will start to see really
more of an exit in India. Mm-hmm.
Absolutely.
I know you have to go. I have one last question before I let you go. What is your sense of the broader Indian geography? There is talent war, clearly. Of course, recently, at least, there's quite a bit of layoffs because of the unicorn situation not going so well and all the fundraising not going so well. But in general, there is talent war. It's a booming market, it's a booming startup market, and so on. Plus, it's a booming market in general with the rest of the ecosystem as well, the MNCs and so forth. So how do you see the rest of India, from a talent pool perspective, second tier, third tier cities, are you seeing your portfolio companies or companies that are pitching to you start leveraging the broader talent pool of India?
I mean, the short answer is yes. We are a very interesting firm in that we are not very IIT heavy. So when you look at the entrepreneurs, especially entrepreneurs of companies that have broken out, not very many of them are IITians. And the other thing that's interesting to note is there isn't sort of a Bangalore heavy, center of excellence presence either. I mean, yes, we have a few that have presence in Bangalore, but it's, Chennai has become a real hub. So many companies. Yeah.
That's because of the Freshworks, I think.
Yeah. I think those two companies definitely. But I need to actually drill further because, especially in Fund 2, I think we have 3 or 4 companies that are Chennai centric. So I need to find out why that is indeed the case. And the second, and we have Kerala. So there's some really interesting companies being developed by.
Very good.
Yeah. So cities that I didn't even know about, right outside of Trivandrum. We've got companies that are building these hubs. I think it's a really interesting opportunity. It's a really, really interesting opportunity for potentially a public-private partnership to emerge. So if state governments, for example, if they take a little bit of a progressive step, in my humble opinion, I think they can attract these startups because there is this sort of talent war going on, and you can use that and leverage that to actually build up that talent pool in your particular geographies. Having said that, we're now seeing companies that have presence in Jaipur, in Bhubaneswar, in Mangalore, in other parts of India, which was not a trend. I would say now it is a trend. And the other thing I'll say is because of this hiccup in the market, and I saw this during the GFC and I saw it back in 99, 2000 as well, is there's a sense of loyalty that starts to percolate in. So employees are not looking at island hopping for 5, 10, 15, 20% increments and go to a different employer. They're saying, you know what, I'm going to stay put. I'm going to actually pay attention to my equity and my vesting and things of that nature. So I think there's going to be a little bit of a mindset shift that happens. I don't think it's going to counter the talent war completely, but it will definitely help. So to answer your question, we are seeing emergence in tier 2 and 3 cities. I think it's an opportunity for, again, government and the private sector to band together to build that the skill foundation, if you will, that startups can tap into downstream. And the third thing is we are seeing companies that have centers of excellence and development in other cities, which I had not seen during my early tenure looking at Indian tech startups.
From the point of view of 1 million by 1 million, our strategy is to train these entrepreneurs who are coming out of those other cities as well. We have entrepreneurs from, I have a very nice team from Chandigarh, for instance, and so forth. So you were talking about the government, private, public partnership, but I also think that some of the secret of making this happen is just training these entrepreneurs, to the level and giving them the access and so forth, just from wherever they are.
Actually, it's very interesting you brought up Chandigarh. So one of the people I really admire is a gentleman named Jay Chaudhary, who's the CEO of Zscaler, which arguably is one of the most incredible success stories. And he set up his development center when he was getting Zscaler going in Chandigarh. Had 350 engineers in Chandigarh. He didn't go to Bangalore. He didn't go to, Delhi or NCR. It was Chandigarh. And he said that was one of the smartest things he did. And as a result, he got that sort of engine cranking. And that has actually led to others popping up as well in those parts of
and that's what Sridhar did in Chennai with Zoho. Is he set up Chennai, and then out of Zoho came Girish Matrabhutam.
Of course.
Freshworks, we had them in the program for 3 years in 2011 to 13.
Amazing. Amazing.
Well, great conversation. Very nice to speak with you, and let's keep in touch.
Absolutely, my pleasure. Anytime.
Bye bye. Take care.
Take care.